Let me ask you a quick question, guys. Was this you on a Friday morning when the markets were in the red? You were like, oh, shit, I can't believe this. Leonardo was saying the whole week the market was going to go through the roof, and it's dropping. Guys, and what did you do? You bought puts. You disregarded all the warnings that I've put out in the last few videos, and you just went ahead, you saw the market in the red, and you said, hell with Leonardo, I'm going to buy puts today. And what happened? Well, for about 15 minutes you had a smile on your face, and then you're like, oh shit, why didn't I listen to Leonardo? Everything is going to the moon. Everything is just turning. And I mean, it just looked like shit was dropping. The minute they're going high, everything is just fucking going high. Jesus Christ, I should have listened to you, Leonardo. I will never do this again. Guys, if that was you on a Friday, okay, if that was you, in this video, I will specifically share 7 crucial things when to be a bull when the markets are actually opening in the red, when it looks like everything is going to hell and everything inside of you screams, buy puts. Just buy some damn puts, dude. Just buy them. Because everything is dropping and hell with everything. Just buy some damn puts. The number one thing, guys, is to understand before you start trading, guys, in the morning, is to make some really solid observations. One of the observations we have shared with our 13 Market Moves Daily Analysis Formula subscribers was this. Right about when the job report numbers were announced, we have noticed a divergence, guys. So point number 1, grab a pen and paper. If you're really trying to learn from these videos, guys, gotta have a solid notebook and write these ideas and characteristics and traits and behaviors down so you can apply them. Because there's no point of listening to all this information if you guys are not sinking it in and applying it in your daily trading. So number 1, write these down, is the divergence. What divergence? What the hell is a divergence? When things look like they're supposed to go opposite directions, but they're actually going in the same direction, okay? That would be a very rare situation in the markets, and that is definitely something to pay attention to. In this particular case, we've revealed in our 13 Markets Move Daily video, before the market opened, that right when the job number came out, the market started dropping. But guess what else started dropping? The VIX, guys, the VIX was starting dropping. Why the hell was the VIX dropping? Guys, you should have seen this huge drop. It drops like from 13 change all the way to 12.04 for about a second. Guys, when you see these kind of moves in the VIX, what was the VIX supposed to do? The VIX was supposed to go higher, and it did ultimately later, and then it reversed and it went lower by the end of the day. But this initial reaction when the report comes out is very, very noteworthy to pay very close attention to. So S&P futures were going down, but so is VIX were going down right at the moment when the report came out. So they were supposed to be doing exactly the opposite. So that happens when a case of a bullish divergence occurs. So write these down. Bullish divergence, guys. Bullish divergence when the market drops and the VIX drops. When you see both of them drop, that is actually bullish. So that's point number 1. Next time you see this, in combination with the other 6 factors that I'm going to describe to you here in just a second, make sure you use that as a warning sign of not to be buying puts. This is actually a warning sign for you to start buying calls. Bullish sign number 2, guys. What we were observing as the markets were dropping, and S&P literally was dropping like 0.5%, almost 1%, like 0.8, 0.9%. But what were your key stocks doing? What was Amazon doing? Was it dropping like crazy? No, it wasn't. Was Apple dropping like crazy? No, it wasn't. So you may be thinking, why are you using Amazon and Apple as examples? They weigh heavily on indexes. So if these key stocks, call them the FANG stocks, call them whatever you want to call them, but any stock that is heavily owned by institution, like institutional ownership in Amazon is almost 100%. It's like 90% plus. So when institutions are not selling these key holdings, that tells you that there's really nothing to worry about as far as the downside. It may look to you like things are going lower, but in reality, pay key attention to these key stocks. They will tell you the real story. They will actually point out to you what's exactly happening. in. In this particular case, what you want to observe is if overall the indexes are going by a larger percentage amount than your key stocks. So in this case, we had markets like S&P index, S&P 500 was going down by almost a percent point, while Amazon was only down about 0.5%. When you see this, this is not the time to be a bear. This is the time to be a bull. So this is your sign number 2, guys. Bullish sign number 3, when you guys look at your screen, you got to be able to measure the volume. When things drop on low volume, this is actually bullish. I know you could be looking at your screen, you could be like, oh my God, everything is dropping, everything is just in the red. But if you notice that things are dropping on low volume, in particular on Friday, when the markets were completely in the red and looked like they would just keep tanking and tanking lower and lower and lower, observe that the volume was extremely thin. It was just like almost no volume. When you see this type of condition, guys, it does not pay to be a bear. It really pays to be a bull. In particular, you could witness Amazon was dropping only in a volume about 300,000-400,000 shares when the markets were opening up. Now, the real volume at Amazon came on the bull side when the reversal intraday happened in move 4. So with that said, if you are clueless how to measure the volume, if you're clueless how to understand, well, what's high volume, what's low volume, guys, we have 20 hours of course material recorded. If you really try to be a great trader, click the links below, take action so you would understand this material so you can trade fearlessly starting tomorrow. This information is simple, and once you understand it, you can apply it each and every day. With that said, bullish sign number 4. Guys, bullish sign number 4, when markets are going lower, certain conditions have to be met. At times, you will have specific days when a widely expected economic data, such as interest rates or a job report or some kind of announcement about tariffs or something important that could impact the market substantially. When that particular day happens, watch very carefully for the initial reaction. If you've been paying very close attention to a lot of videos I've been posting lately, I keep saying that initial reactions are not always your true reactions on days like this. When we talk about individual stocks, for example, a lot of times when you take highly speculative stocks like biopharmaceutical stocks that announce their data on their drugs, or you take stocks like Tesla. Basically, it's a specific date that all the market participants are expecting. And when that news comes out of the report, of the data, of the whatever the market was expecting, the initial reaction oftentimes is not going to be your true reaction. So wait to determine which side of the trade you should really be on. So whatever the initial reaction is, in this particular case, the initial reaction to the job report was lower. So what you actually want to do is you want to play the opposite side of the equation. So that is your bullish sign number 4. When the market expects a particular event to take place on a particular time, watch out for the initial reaction and place the trade in the opposite direction of the actual initial reaction. Bullish sign number 5, when markets are opening in the red. If that takes place when the market over the last 5 days to 3 weeks have been in a solid uptrend, okay? If that move lower is substantially higher than the prior moves lower, if you are in an uptrend, meaning that the market is creating a series of higher lows, if you know how to draw the uptrend, guys, if you're brand new, hey, look, you've got to just get the basics down. We talk a lot about all kinds of stuff that could be helpful to you is understanding the trends, the trend reversal specifically on the stock charts to really help you make sense out of this markets on day-to-day and weekly basis. So basically, when the market is in the uptrend, it creates a series of higher lows. What you want to do on a pullback, the strategy that really pays is to buy the dip. It's that simple, guys. So now you don't want to do that. Clearly, if the market is making a downtrend and it opens lower with a gap down, that would be a totally different market environment. And to differentiate the two, guys, I invite you to take our charts and divergences course. It's really going to make everything nice and clear to you in a very systematic way. Just click the links below and take advantage of it. Bullish sign number 6 when the markets are opening in the red, guys. If the predominant institutional behavior over the last 5 days to 3 weeks have been such that they're buying the smaller dips, and that's exactly based on our 13 markets move formula is what we calculated every time the market made a smaller dip. You probably remember the video I've posted recently talking about the market sequence 777, the market sequence that is highly bullish. So in this type of market environment, when the predominant behavior institutional investors is to buy the dip, and the dips that we've had over the last 7 to 14 days have not been as big in its size as the one that the market initiated the open with on Friday. So the reason in here is quite simple. If they have been buying the smaller dips over the last course of the last 2 weeks, what do you think the institutional investors are going to do when a slightly larger dip is going to take place? Guys, they're going to buy the damn dip, and so should you. So if you haven't been subscribed to our 13 markets move formula, guys, that is specifically what we've told our subscribers is just buy the damn dip. It's not that complicated. Damn it, just do it. And bullish sign number 7, the most powerful of all, because it combines all the ones that we have just discussed, plus it combines our proprietary strategy, the 13 markets move formula. When we observe certain sequences, the probability of the market actually reversing and completely going in bear mode is next to nothing. So when we calculate the probability of the market to actually continuously move higher, we assign a probability of 80 to 90%. It just pays to be on the right side of the equation by observing the 13 markets move sequence. And if you've never heard about it, guys, I invite you to check it out. It looks at a ton of stuff that typically nobody talks about in the news. And if you understand it, how simple it is to actually utilize it on day-to-day basis, you're going to look at yourself in the mirror and you're going to say, what the hell have I been waiting for? Why haven't I studied it before? Leonardo, where the hell have you been? Where's the link? Give me the link right now. I want to study the hell out of the 13 move formula so I can be the best trader ever. If this is how you feel, guys, check this out. It's nice and simple. Click that link below. Take action so you can make this year your best trading year ever. I'll catch you guys on the next trade.